Good morning, ladies and gentlemen, and welcome to the ARGENTEX Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from ARGENTEX Group PLC. Jim, good morning, sir.
Good morning, Jay. Thank you for that. Good morning, everyone. Nice to see you on Results Day today. You've got Guy Rudolph, our CFO, as well as myself, CEO. I will take you through slides, giving you an overview of where we've got to and where we're heading. So a quick reminder of what we're doing and why, and this is a similar slide to that which we shared with investors last May, shows really where we've come from and what we expect to achieve by delivering on our transformational plans. This is a very clear vision of where we want to be, much more than just an FX provider, a true full-service fintech, targeting the upper echelons of the corporate and institutional segments, as we've done for the last decade. We are investing responsibly to drive our scale, diversify our revenue streams, and of course, subsequent returns for the longer term. This is about exploiting wider markets and driving better margins through operational gearing in the longer term. But we've got to build the technology and the processes to enable that to happen. So we are very focused on what our objectives are, fixated on returning to profitable growth, but also ensuring stronger client retention and greater wallet share. And we're really pleased with the progress that we've made. We have focused fully on fixing the things that we needed to fix, committing to the three core pillars of our strategy, and I'll take you through some of that detail. Our strategy is to reside on three pillars of operational excellence, product diversification, and geographic expansion. So really it's about fixing, then building, and then growing. We've been incredibly busy preparing the business for a return to growth, and we're very proud of what we've managed to achieve in the time that we've been here so far. I'm going to give you a few examples of the sort of things we've been doing, but this is by no means an exhaustive list. So we've implemented NetSuite as our finance ERP. We've adopted Salesforce as the backbone to all of our CRM processes. We've introduced a strong budget and quarterly reforecast process, holding cost centre managers firmly to account, including a reduction in T&E spend by more than £200,000 year on year and other cost reductions across the board. We've improved our risk management processes, introducing the GRC tool LogicGate to support and control these processes. We recruited an experienced IT leadership team to enhance old technology while simultaneously building a new global platform. So we're turning a rudimentary voice brokering FX business into a scalable, diversified fintech. We've restructured the front office and now have a new key accounts team, a new origination team. We've changed how we identify and hunt down new prospects, and we've changed how we pay commissions from forever payments to a 3-year cycle. We're building technology, product, and geographic footprints that will allow us to grow and expand without myriad manual processes that dogged the business previously. This includes new licenses in the Middle East and Australia. That means that we're now represented in 4 distinct territories with a standard product set that can be deployed into any new branches in the future in real time. We set clear technology milestones before the launch of our new digital accounts and payments products in the summer this year, and we've hit every milestone with time and budget to spare. We've only one milestone remaining before we launch, and we're confident of achieving that again to budget and on time. So let me hand over to Guy now, and we'll talk through some of the financial highlights for the past year.
Thanks, Jim. So on this page, some highlights, and then I'll go through each of the primary statements one by one. Firstly, full year revenues and EBITDA margin are well ahead of our guidance of mid-40 million, which we issued last May, and ahead of the expectations that we presented when we put out our half-on results last September. So that 50.3 million of revenue, marginally ahead of last year, and I'll cover later how we saw strong H2 growth and momentum that's carried into FY25. EBITDA was 4 million, a margin at 8%, significantly better than the low single-digit margin in our guidance. And I'll discuss the walk later of EBITDA from one year to the next. But looking operationally at the business, the bottom two KPIs, our teams continue to win new business and more clients trading the year with us, and new client revenue was ahead of the prior year. But as I commented in May and September last year, the mix of spot and forwards versus in FY24 versus last year has changed. And this has meant higher levels of activity generating similar levels of revenues as the prior year. If I move to the P&L, really 3 points on the profit and loss account I'll pick out on an individual slide on each. Firstly, improving momentum in H2 and volumes up, but with some margin compression, as I just noted. Staffing levels and costs, we did increase our average headcount in FY24 compared to FY23 by 18%, driving some of that increased cost. But I'll unpick on a separate slide the work we've done in controlling that headcount and cost base. And lastly, in the year, we have experienced a number of material costs which we believe are one-off in nature, mainly related to the change in management and the repivoting of the business that are unlikely to reoccur. And I'll also explain those to you. So really looking at the top of the P&L and revenues, really positive story for us, gathering momentum in H2, which continued into Q1 of FY25. The strong recovery in H2 reflects really two facts: our focus on client quality and their retention, and really having customer lifetime value at the centre of what we're doing, and a more favourable market experience in H2 and into Q1 as well, probably as a result of macroeconomic effects that I think we're probably all aware of. But really the very encouraging thing for me is that with better revenues from our clients, we're seeing better revenues from clients in year 1 and 2 of them being our clients. We focus on these clients, deliver a better customer experience, reflecting our better CRM processes, our more effective customer engagement, and the focus on retention and differentiating ourselves. And now onto the headcount story and our workforce. We've rebalanced the workforce to focus on delivering the new strategy that Jim outlined. We've worked all year on this, and we've got a strong grip on these costs. We entered the year with 196 heads, if you are looking at the chart on the left. And actually, in the early months of this year, that went significantly above 200. But we've managed that headcount base through attrition, through performance management, and through challenging every backfill. And we're very pleased that the FTE, if you like, running the core business, we've reduced from 184 to 160 people, taking that down by 13%. And effectively, those heads and that cost being recycled in the areas of growth, which we signalled we were going to drive as a strategy. Net new 5 heads in Dubai and Australia, and 19 heads building the new platform that will support our delivery of payment services and accounts to customers. I think also importantly, the piece at the bottom, whilst staff costs have increased overall, our average cost by FTE has really increased in line with that, and it is flat. If you see, we've got average FTE growth of 18%, cost 19%, and that really, again, is us investing in some more experienced IT hires, upskilling essential engineering skills as we drive the AGP build. And lastly, unpicking the P&L, if I move to our EBITDA walk, and to explain our year-on-year margin and movement. So normally I'll be pretty linear and go from left to right, but I think what I'd like to do is unpick the bookends of both of these first, and then talk about the underlying. So we look at last year's numbers in FY23, 11.9 million and a 24% EBITDA margin. Of that, probably boosted by 700,000 through provision releases that were one-off, offset by some one-off costs that we wouldn't think would be reoccurring in that year. So probably last year, an underlying margin of 22%, on 11.2 million in EBITDA. If I come to the right-hand side, we've just posted our results this morning. EBITDA of 4 million and an 8% margin. But included in that number, we've taken a number of one-off charges of 2.7 million. The first one of those really from the restructuring of the business, changes in the first half of the year. The cancellation of the old LTIP, a non-cash item, an accounting entry of 600,000, and also a default that we provided for one ARGENTEX contract for a customer. The first such experience that we've had in the last 3 years. And that would give us sort of an underlying this year of 13% margin on 6.7 million. And really the walk between the two, if I come to the middle of that sort of walk, the two items where we're investing in growth drivers of depressing that margin in this year. 1.1 million incremental investment in Australia and Dubai. Those offices are now both fully functional and operational and ready to win business. And secondly, the cost of that increased headcount raised in FY24 that I mentioned before, moving from 169 average in the prior year to 199 average, reflecting investment in senior engineers and IT resources to build our platform. On to the cash flow. Really a relatively simple story. Closing net cash in line with the prior year, leaving us in a strong position. And effectively, the net proceeds we raised from the equity raise last May being absorbed by the business we invest into the platform going forward. On to the balance sheet. At first glance, there appears to be some big movements and changes to our balance sheet, but really there's only one significant movement in there, which is highlighted in blue, and that's an increase in other assets of 8.5 million. And that is principally where, due to the regular requirements, we need to propose our cash into our cash regulated clients' balances, which we ring fence for them. The other key message from this, again, is closing cash is strong and a similar level as FY23 and gives us a strong balance sheet to continue our activities and to build the business. So before I wrap up and I hand back to Jim, key takeaways for me on this last year results. We've exceeded our revenue and margin guidance expectations. We have managed the cost base tightly, in particular managing the FTE to be flat at 197 closing, bringing underlying headcount down by 13%, reinvesting that in the growth areas for FY24 and beyond. The balance sheet remains strong, and a better than expected year with strong momentum in H2 has continued into Q1. And overall, I feel extremely positive about FY25, and I think we're well set for a return to meaningful revenue growth.
Thanks, Guy. I think it is a simple story, this. We are getting on with the execution of the plan that we set out in the last round of our investor presentations. To Guy's point, we are running the core business with less people than we had previously, and we're investing in areas of growth. We've built new efficiencies and capabilities into our front office to enable us to take advantage of revenue opportunities when market conditions allow. We're building automation into all of our processes, front and back office, and we're focused on driving profitable long-term growth with the potential to expand margins as our scale increases. This is all about setting ourselves up for success. And this was obvious in H2 when trading momentum accelerated, and it's a trend we're pleased to have seen carry on into the first part of this year. Our new ARGENTEX global platform will host not just FX services, but also digital accounts in the alternative banking space and payments, as well as any new products that we build in the future with no legacy systems, a next-gen approach to tech, and also to product delivery. But more importantly, to client experience. Refinement will be ongoing, but this is not a so what solution. It's a product set designed to win new business and service existing clients in the face of fierce competition within the segment. Let me just talk geographically for a moment. I won't spend too long on this slide. The Netherlands has been trading since 2022 and was our passport into Europe post-Brexit. So it's an operation on the compliance hub there, but the team is expanding and continuing to drive revenue, and we'll be applying for a MiFID Pro license this year in the Netherlands region, which will allow us to sell structured solutions, i.e. options, more freely across Europe. This business is being carefully managed by Jon Andreasen and is now starting to contribute meaningfully to group revenues. We've also pleased to report strong momentum in Australia and Dubai. Australia's been trading since December. Dubai has just started trading in its own right after obtaining a 3D license in late 24, and we're now building our operational resilience and sales capability with expanding teams in both of these branches. Fully focused on market opportunity, these were not simply license plays, and we will continue to open new branches in the future, but not driven by licensing need, more by market opportunity, but will only expand affordably as the existing teams generate enough revenue to fuel further expansion. Product diversification, key part of our strategy going forwards. We used to have just FX services. This summer we launched digital accounts, the alternative banking proposition we've been talking about for a while, which has the potential to contribute to scale with multiple revenue streams. We have built over the last 9 or 10 months the end-to-end seamless platform, which will facilitate speedy onboarding for clients and easy API integration across both clients and enterprise partners. Forgive me. We've had this technology team for a while, but we've also now got the sales and marketing leadership in situ, and the market opportunity that we see in front of us is probably better than we anticipated. I don't think anybody is providing this service perfectly, particularly in our core segments for fund managers and sophisticated corporates, and we think this remains a real opportunity for us. Our first iteration of the global platform will also include mass payments products, and we'll be hiring a specialist team to grow this side of the business in H2 of this year. So we'll talk more about that as the year develops. I think it's important to acknowledge that competitors have been quick to market, and we've had to respond with a future-proof solution that puts client experience very much at the heart of our offering. Frankly, mediocre was never going to cut it. Sophisticated clients need smarter, seamless solutions with easy integration, fast onboarding. We can do both. The market opportunity is clearly significant, but unlike most of our competitors, we've already got a meaningful roster of institutional clients that we'll be targeting from launch. We know from market data and from those existing customers that account fees are recurring, they are reliable, and there is the potential to earn additional revenue from interest on operational balances, as well as sharing interest on depository accounts. We intend to do both. We also know that when we bank clients, they trust us more and use us more for traditional FX services. Payments is an enormous market in its own right, but requires specialist focus. And so that team that we'll put in the latter half of this year will drive us opportunity. But this is also about client retention and lifetime value through service quality, diversity of products, not just a simple FX service, and certainly one that's not based on just price. So in summary, key messages from us: we're doing everything that we said we would, on time, on budget, with strong momentum against every conceivable measure. This has not been a small amount of work, not some minor service. It's been a major overhaul of the business, and we've delivered in every way possible. We anticipate that our technology and products will be market leading. We've got strong momentum across all territories and in our core FX business. We're focused on running the business efficiently and towards scale, and the executive team are fully and permanently committed to delivering this transformation, which we hope will drive shareholder value, but we'll let the market decide that. We're just going to stay focused on executing our plan and giving clients the quality of service they truly deserve. Go on.
Thanks, Jim. I think a great summary. And just from a financial angle, I feel very confident. We're generating cash. Our results are on track. Trading throughout Q1 has shown improved momentum. I feel really confident about the year we've got ahead and the delivery, and we'll execute our plans. Thank you.
Thanks, everybody. We're really happy to take some questions.
Perfect. Jim, Guy, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have come in already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, as you can see there, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But Mark, at this point, sir, if I may hand over to you to chair the Q&A with the team. And if I pick up from you at the end, that would be great. Thank you.
Sure. Hi, everybody. My name is Mark James. I head up investor relations here at ARGENTEX. I echo what Jake says. Please keep the questions coming. We do want to engage. There's a couple here that I think we may have actually addressed during the presentation because they came in at the start, but let's go back to them anyhow. So, how's the international expansion progressing? Will this continue with more new offices? I think we probably did address most of that, but perhaps that last point, Jim, if you could elaborate a little bit on our view about new offices.
Sure. This is about affordability and not extending ourselves from a capital perspective. So as the new branches that we've already brought on stream in 24 and previously in 22 with the Netherlands continue to expand and deliver more meaningful revenues, we will look at other market opportunities, but we won't be pushing too aggressively and extending ourselves unnecessarily.
Thanks. And again, we sort of touched on this, but I'll read it out anyhow. Client numbers grew by 9%, yet average revenue per client also fell. Can you, so revenue per client was down 9% year on year. Can you give a clearer explanation of what's going wrong? Now, we I think, addressed that in terms of the momentum in the second half.
Yeah.
Guy.
Yeah. I mean, I'm happy to pick that up. I don't think anything's going wrong, actually. I think the market conditions here are, first 9 months of the year, relatively low levels of volatility. And when we have low levels of volatility, it's a competitive market. The spread on the forwards and options and also on spot narrows a little bit. In FY25 and in the second half, the last quarter of FY24, we saw slightly more volatility and slightly wider spreads on forwards and options, and that's consistent with what we've seen in previous periods. So overall, I think that what you need to look at is the volumes. That there's a notional volume that we're doing our trades on, so we're doing more trades than not notional volume, but really it's a rate times volume play, and so the rate marginally lower, and that's picked up in the last quarter of the year and into this year. So I think in any market, pricing is driven by competition and market volatility, and so we have seen those spreads expand a little bit in Q4 and into Q1.
There's a couple of pre-submitted questions here. What is the extent of management stroke board ownership, and are you going to buy more shares? Obviously, we can't talk to the latter part of that, but
yes, very happy to say that. As of sort of the last share register I had at the end of February, about board management, excluding Pacific, who are a majority shareholder, and where we have one board member there, is about 2%. We can't comment whether we're buying more shares, but I think it's fair to say that we've just come out today of a 3.5-month long close period for us.
But if we do buy shares, those trades are being announced in the ordinary course. But be assured, we are personally very committed to this business, and I'm sure that'll be reflected.
There have been a few which I'll aggregate around incentive schemes. Obviously, we've put out RNSs in that respect. I wonder if you can maybe address that in terms of what we're doing across the business, Jim.
Yeah, happy to. I mean, what we've really done is replaced one rather vanilla long-term incentive plan that was applied to the wider business with 3 different schemes. So an LTIP for the executive team, ESOP for middle and back office, but for those sort of high-earning front office staff that really contribute to revenues. I don't think either of those schemes are conceptually very helpful for delivering the right and appropriate amount of reward. So there we'll be looking at a different scheme altogether around sort of share options based on revenue performance, and we've brought in external advisors to help us with that. So 3 schemes, not 1, is how we see it going forward.
Thanks. Here's one which, again, I think we sort of covered, but perhaps it's worth elaborating a little bit. Diversification of revenue mix over the next few years. How do you anticipate this transitioning as digital accounts and payments become a larger part of the business? Guy, do you want to sort of have a go at that in terms of revenue mix and its impact on gear?
Might I just frame
Yeah.
sort of the conceptual side
Sure.
of that before I talk to some of the detail? But unusually and helpfully, I think there's real peer precedent in this segment. So you can see how competitors have expanded their product streams, and clearly we're following to an extent a similar journey, but we're more focused, I think, on delivery in terms of the quality of the products that we're building. So I think diversification is really a push around client retention, around adding value, but also around quality of earnings, which I might pick up on.
Yeah, I think we see obviously there will be an opportunity for us to charge for account fees and also payment fees. And I think the third element, which will probably benefit, which we could see our competitors do as well, is that when balances go in and out of those accounts, we will also benefit from interest income on them, which we will class other income, and that is how we'll diversify.
Thank you. There's a couple here. Well, I'll read them out, both of them out, but they're sort of the same gist. The Trump administration might weaken the US dollar and the UK pound may strengthen. How will this scenario impact your business? And on the same note, in the current environment of global disruption in markets, where do you see the greatest opportunities? So I think it's just a generic question about volatility in the markets, how it's affecting us.
Yeah. I mean, so I think the first thing to frame this is 85% of our activity and revenues is generated from euro dollar and GBP dollar. So I think that frames that. I think that my observation, I'd say, is that for corporate treasurers who are and CFOs who are looking to hedge, when there are more significant movements and volatility, they are more likely to make decisions to lock in prices at known amounts, because their treasury policies give them a amount of scope and they tend to move to more. So I think what I'd say is that overall, those high levels of volatility are generally good for us, as our clients seek to minimize the risk or lock in to known risks a little bit earlier than they might have done otherwise.
Yeah, absolutely right, guys. Stuart being a few others have asked some really good questions around some similar things here. I don't think it matters really where currencies move to. It's more about the fact that they're moving at all. And there's also a fear factor element here. You know, clients are driven to transact if they're nervous or lacking in confidence about the direction of travel. So yes, it's volatility, but it's broader than that. And we just want to see currencies moving, and elements of trepidation around predictability, which always helps.
There's a question here. Who do you see as your competitors? Perhaps if I widen that a little bit to just the competitive landscape in general, especially as we go into new services.
Yeah, sure. I think historically the answer might well have been, you know, it's the banks, and we're out there to take a specialist perspective around the provision of FX services. As we broaden our product set, I think the competitive landscape becomes rather broader. I think it's easy to point to peers, and we need to acknowledge the quality of some of those competitors who've done frankly a very good job of bringing product to market swiftly and setting the tone for the segment. So, you know, whether you're talking about Ebury or Equals or Alpha or Convera or Corpay, you know, it is a really competitive space, always has been. And we have to be very clear on what our differentiators are in multiple territories, and it's different for most of them, and also in the products that we deliver.
There's a couple of questions really around our exposure to risk and the management of risk. What share of your trade is on a fee/commission basis, and what, if any, is exposed to risk, and how is this managed?
Historically, the business has always been really transactional.
Yeah.
And the core business will remain so, I suspect. I do think there is an opportunity to go further up the value chain and think differently about how we charge and take a more consultative approach. There was a good question earlier around providing treasury support and advice, which we've always done as part of the bespoke and tailored way that we interact with clients. But I think there's opportunity in that direction. So I think you can expect in the longer term for us to think more structurally around how we charge, how we engage, how we advise, and some of the products and services that we'll be looking to deliver on the platform in later years.
Yeah, I mean, I think if we just talk about, to clarify for that question, I think from Dave R, for our FY24 results, 100% of our revenues are coming from what are called the spreads that we get on spots and forwards, and the premium we get on options, which is for more sophisticated clients where they may have more complex forwards, aka an option. So at the moment we are all on straight fees on a transaction by transaction basis, and simple, and that will probably change in the future.
It may be too early, given we haven't launched these services, to ask this question, but if I read out this one, going back to the interest income revenue point, have potential rate reductions been factored into the thinking around the amount expected?
Interest rates are out of our control. The potential to earn from interest is clearly there. Our competitors have proven that, but we need to be really prudent about how we think around that in terms of guidance and advice to our advisors. So we're not making any sort of bold claims around that. We won't be in the future either.
And one of the real, I think Jim mentioned this and talked, one of the real benefits for us is there is a probably benefit. There may be some interest income on balances that are held in a short term in a buyback. However, the real point for us is that it's a facilitator that we believe our clients will be stickier and more likely to use us if we're providing that facility to them to support our existing core business.
Yeah, we don't want to say that the opportunity doesn't exist. It clearly does, and it could be a significant opportunity. But I think we need to be circumspect around how we guide.
Please, by the way, do keep your questions coming. We all appreciate them. I've got a couple more here. How do you acquire new clients in your new territories? So customer acquisition across the globe.
Yeah, I mean, the territories are all markedly different, but fundamentally the principles of client acquisition are broadly the same in that we're becoming more sophisticated. I think it's probably fair to say that historically there was an element of a volume play around calling prospects. We're much more sophisticated with the introduction of Salesforce and a really advanced CRM lens to how we target prospects, how we launch campaigns, how we use marketing. So we're becoming more grown up, I think, more sophisticated, cleverer in how we win new business, and also the type of business that we're targeting. We're laser focused on what good looks like. So I don't think it varies dramatically whether you're talking about Australia or Dubai or the UK or the rest of Europe. But some areas lend themselves to being targeted slightly differently. So, for example, Australia, more import-export. Dubai, lots of financial services. Netherlands, sort of more broad brush, similar to the UK, for the rest of Europe. So there are nuances, but fundamentally, the strategy is one of becoming more sophisticated, not less so.
There's a question here. Obviously, most of our work and our presentation is about our organic growth. There is a question here: is there an M&A plan, stroke potential for one? So people are asking about inorganic possibilities.
Yeah, I mean, without being sort of too tongue-in-cheek, we have a very stringent finance department, and strategically, there's lots of new shiny things I'd love to go and have a look at. But we can only do that, and we can afford to do that. And I think as the business grows, the business becomes more valuable. If we do all the things that we're doing correctly, there will be opportunity. And there are certain areas where I think it's interesting to look further up the value chain, products that you probably wouldn't want to build yourself, but we're not there yet. Yeah.
Perfect. That's the end of all the ones that the questions have been submitted. If I can just ask, please do feel free to contact us at any time. You can get a hold of me. Oh, sorry.
I just spotted one here that says, in light of respect to the 2.7 million bad debt in 24. Let me just clarify if I wasn't clear the first time round. Not bad debts. In FY24, we had 3 costs that we are hopeful, or two of them that we're very sure won't reoccur, and the other one we're clearly very hopeful won't reoccur. And I want to highlight those that they're not recurring, but with unknown numbers. The first of that was that effectively the cost of the reset of the business, the repivot and the management changes and exiting or management and bringing new and some of the double running costs of that was about £1.5 million. The second element of that was that we had to, and that was a cash cost as well. The second element of that was 600,000 P&L cost, no cash cost of us closing the old LTIP, the old VCP LTIP plan. That was a plan that was had no chance of vesting, had already failed in its meeting conditions, and that was a technical accounting entry that we had to book. But there's only one bad debt, and it's the only bad debt that we've experienced in the last certainly 3 years, and that's of a client that when we asked them for their margin call, didn't pay, and accordingly we closed out those trades. We provided against that for £600,000.
Not written off, provided for. And there is a cost to doing business in the segment. We are effectively extending credit to certain customers. And if we margin call them and they aren't paying, in this instance because a factory had burnt down, occasionally you get caught with it. It's not a regular occurrence, as Guy says. It's only happened once in 3 years, but it does happen occasionally.
Yeah.
In terms of learnings, I think what we would say, we have a very stringent credit process. It works very well. It's very clear on what the credit committee is designed to do. It meets on a very regular basis, and we monitor all trades, real time. So we're very happy with the processes and procedures that sit around the provision of credit and how we manage those customer interactions.
Yeah, well, yeah, that's absolutely.
Thanks. Just a reminder, you can always get hold of me at mark.james@argentex.com or all of us indeed at investorrelations@argentex.com. But for now, I'll hand back to the moderator.
Thanks, Mark.
Perfect, guys. That's great. And thank you very much indeed for being so generous of your time there and addressing all of those questions that came in this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended. But Jim, perhaps before now, just really looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company. If I could please just ask you for a few closing comments just to wrap up with, that would be great.
No problem, Jay. Thank you. Guys, we are an open business, a transparent business, a well-governed public company. We welcome interaction with our stakeholders. As Mark said, we're very happy to take questions at any time, not just today, but at any time in the future. We've made a principal point of making ourselves available, not just for these presentations, but for presentations and updates throughout the year. So do be in touch with us if we can answer any questions that we haven't answered fully today. We welcome that interaction with you, and we look forward to updating you in due course as the business progresses.
Perfect, Jim. That's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ARGENTEX Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.